The strange thing about market crashes is that the biggest money is rarely made during the scary part. It is made in the quiet moment right after, when the crowd is still staring at the fire and power is already moving behind the walls. A war can destroy confidence, spike oil, shake currencies, and still create huge upside for a small group of people. Not because they are braver than everyone else, and not because they know secret headlines before the public does. They win because they understand what governments, central banks, and markets usually do once the pain gets too expensive to ignore. If you like hearing the part of the story that usually stays hidden until after the move is over, keep this channel close, because the turn nobody is watching is where this really starts. Right now, most people are doing one of two things. They are either rushing into whatever already went up, or they are so nervous they cannot act at all. Both reactions feel safe in the moment, and both can be costly. Look at the mood when a conflict begins to spread through the economy. Oil jumps, headlines get darker, consumer confidence sinks, and every conversation starts to sound like a countdown clock. People assume the danger is obvious, so the trade must be obvious too. Buy energy, buy defense, hide in cash, and wait for the dust to settle. But markets are not a movie. They do not reward the person who points at the explosion and says, "See, I knew it." They reward the person who asks a harder question. What breaks first? What bends later? And what gets rescued once the people in charge realize the damage is no longer contained? That is where most investors lose the plot. They think a crisis is one event. It is not. It is a chain reaction, and each link matters more than the headline before it. The first move is fear, but the second move is policy, and the third move is repricing. That third move is where fortunes can change fast, because by the time officials start trying to soften the blow, the market has usually crushed everything together. Strong businesses get sold with weak ones, useful assets get dumped with broken ones, quality gets marked down simply because panic does not stop to read balance sheets. So if oil is surging and the war risk is real, why would anything outside the obvious winners recover? Because high energy prices do not just raise inflation, they also slow the whole machine. They act like a hidden tax on households, companies, transport, manufacturing, and confidence all at once. And when that hidden tax gets large enough, the conversation changes. At first, everyone worries about rising prices. Then, after enough strain, the bigger fear becomes falling growth. That matters because central banks respond very differently to those two problems. Inflation makes them cautious. Weak growth makes them flexible. And if you come here for the part of the market story most people only understand after the rebound, stay with me, because this shift from price pain to growth fear is the hinge the whole setup turns on. A bond yield is the return investors demand to lend money to the government. When yields stop climbing and start slipping even while oil stays elevated, that is a clue. It suggests big money is beginning to worry more about slowdown than inflation. That sounds small, but it changes everything. Because once the market starts believing economic pain will force a response, investors stop asking only what gets hurt now. They start asking what snaps back when support arrives. And those are very different lists. Think of a shopping mall during a sudden power outage. In the first minute, everybody runs for the exit. No one stops to ask which stores are actually damaged and which ones just lost the lights. But later, when backup power kicks in, the strong stores reopen fast. The ones with deeper problems stay dark. Markets work the same way in a shock. Step one is blind selling. Step two is selective survival. Step three is violent revaluation, when people realize they priced too much permanent damage into temporary fear. By then, the easy money from the obvious trade is often gone. That is why chasing what already exploded higher can be such a trap. The crowd sees oil producers climbing and assumes the safest bet is the thing already running. But late entries into crowded winners often carry the worst timing. The market has a cruel habit of rewarding the early idea and punishing the late copy. A better question is this: which assets are being sold because they are genuinely impaired, and which ones are being sold because investors need cash, hate uncertainty, or simply cannot tell the difference in the middle of a storm. That single question can save years of regret. It is the line between reacting and thinking. If you are the kind of person who wants the map before the stampede, this is the part to pay attention to, because once you separate the truly damaged from the merely discounted, the whole mess starts to look less random. Let's call the first group cracked. These are businesses and sectors that the shock hits directly and hard. Then there is the second group, bruised. These are assets the market punishes emotionally before the real economics justify it. Cracked businesses are the ones with no room for error. Airlines with fuel cost pressure can get squeezed quickly. Highly indebted companies that need cheap borrowing can run into trouble fast. Consumer brands that depend on weak households spending freely may discover that the customer simply disappears. You can add another fragile group to that list. Businesses with thin margins and long supply chains across unstable regions. If shipping routes are disrupted or insurance costs surge, a weak company has nowhere to hide. It does not need to go bankrupt to disappoint investors. It only needs to lose flexibility. Now look at the bruise side. A software firm with sticky customers and strong cash flow does not suddenly become worthless because oil spiked for several weeks. A payment company that handles millions of everyday transactions may face fear-driven selling even if its long-term business remains intact. A quality retailer serving domestic demand can be marked down like a collapse story when it is really a patient story. This is why crisis investing is not about buying chaos. It is about buying resilience on sale. That sounds simple, but it is emotionally difficult, because when prices are down and headlines are ugly, the human brain confuses discomfort with danger. Sometimes they are the same thing, but often they are not. One area people often miss is the plumbing of energy, not just the producers. When markets panic over oil, everyone talks about the companies pumping it out of the ground. But the steady money can sit one layer deeper. Storage, transport, terminals, pipelines, export links, and the infrastructure that keeps energy moving can benefit from stress without depending as heavily on perfectly guessing the commodity price itself. That part of the market behaves more like a toll road than a lottery ticket. If energy has to move, someone gets paid to carry, store, route, or process it. And when a global disruption pushes countries to rethink supply security, those networks can become even more valuable. The world does not only need fuel, it needs dependable ways to move fuel around political choke points. Another overlooked pocket sits in the broader security chain. Not only big-name defense contractors, but companies tied to maintenance, communications, surveillance, satellites, logistics, and cyber defense. When governments feel exposed, spending rarely stays narrow. It spreads into the systems that keep military power, digital infrastructure, and supply coordination working at once. That matters because wars change budgets long after the headlines cool down. A missile strike is instant. A procurement cycle can last years. A government that feels embarrassed or vulnerable does not usually solve that feeling for one quarter and move on. It rebuilds capacity, hardens networks, and spends for longer than the public expects. If this kind of breakdown helps you stay calm while everyone else is staring at the loudest headline, keep this channel nearby, because the next piece is where fear starts creating the discounts that look unbelievable in hindsight. The most interesting opportunities often show up in places that seem wrong at first glance. That is exactly why they work. They are uncomfortable enough that most people refuse to touch them until the rebound is halfway done. Take consumer-facing companies. In a war-driven shock, investors often assume households will stop spending across the board. Sometimes they do cut back, especially on optional stuff. But the market often punishes the whole category as if every business is about to face the same collapse. That broad brush selling can open the door for high-quality names that were thrown out with weaker ones. The key is not buying consumer as one giant bucket. It is looking for companies with strong brands, manageable debt, loyal customers, and enough cash to survive a rough patch. When fear hits maximum intensity, even solid businesses can trade like disaster stories. And when confidence stabilizes, those same names can rebound far faster than people imagine. The same logic applies to technology, especially software and digital infrastructure. During a panic, people dump what they own, not only what is broken. So, fast-growing software, cloud services, automation tools, and business platforms can get hit simply because they are liquid and easy to sell. That does not mean their long-term demand vanished. In fact, some forms of tech become more useful in hard times. Companies under pressure want efficiency. They want automation, data, cost control, faster decision-making, and better security. If a software business helps customers save money or operate better, a crisis does not erase that need. Sometimes it sharpens it. Then there is finance. Not every lender benefits in a stressful market. Weak balance sheets and bad loans can become a problem quickly. But certain financial businesses improve when the market begins to believe rates will ease and conditions will eventually soften. Payment firms, strong consumer lenders, exchanges, asset managers, and insurers can all react differently depending on how the policy path changes. The important thing is to understand the direction of the pressure. If borrowing costs are likely to stop rising and maybe fall later, the market will begin repricing businesses that suffered under the fear of permanently tight money. Again, not all of them, only the ones built to survive the storm. Crisis creates discounts, but it does not cancel quality control. Precious metals can also confuse people during these moments. Many assume that if fear is rising, gold should rise every single day. But in real liquidations, even strong hedges can get sold. Funds need cash, margin calls hit, and assets people plan to keep get dumped simply because they are one of the few things still worth selling. That kind of selling can say more about stress than about long-term value. So the market is not asking one simple question. It is asking several at once. What is broken now? What will officials try to support next? What did the crowd oversell? And who has the balance sheet to still be standing when the mood turns? If you want more videos that turn messy headlines into a cleaner decision process, stay with me, because now we need to talk about the timing trap that catches even smart investors. Most people think the right moment to buy comes after the danger is gone. It almost never works that way. By the time the all clear feels comfortable, the price usually knows long before your emotions do. This is where a lot of people get frustrated. They wait for the ceasefire. They wait for oil to fall. They wait for one central bank speech that sounds gentle. They wait for the market to stop feeling scary. Then they discover the market already moved 20, 30, or 40% off the lows without them. Why? Because markets discount the future. That means they move on expectation, not ceremony. The rebound often starts when the news is still ugly, but becoming less bad at the edges. A shipping route partially reopens. An emergency reserve release calms the oil curve. A policymaker changes tone from fighting inflation at all costs to protecting growth and financial stability. Sometimes the shift comes through direct action. Sometimes it comes through smaller signals, bond purchases, liquidity support, tax relief, strategic reserve use, diplomatic back channels, temporary waivers, or fiscal packages can all change the mood before the public sees a neat headline that says the danger is over. The market trades the direction of official behavior, not the poetry of the press conference. That is why the most useful signals are often indirect. If oil stops making higher highs, even as the news stays tense, pay attention. If bond yields soften while pundits are still talking about inflation, pay attention. If the dollar loses some of its panic bid or volatility spikes stop getting bigger, pay attention. These are not guarantees, but they are clues. The crowd likes certainty. Markets like anticipation. That difference is where so much money changes hands. People tell themselves they are being disciplined by waiting. Sometimes they are, but sometimes they are only buying emotional comfort at a very high price. There is another danger too: leverage. That is, borrowed money used to make a bigger bet than your own cash would allow. It feels smart when prices are rising. In a volatile market, it can turn a temporary drawdown into a forced sale at exactly the wrong time. And if hidden signals like these are the kind of thing you never want to notice too late, keep this channel in your rotation, because leverage is where good analysis often dies before it gets a chance to be right. You can have the right thesis and still lose. If your timing is early and your position is too large, the market can simply knock you out. Then the move you expected finally happens without you. That is why crisis investors who survive tend to think in layers, not all or nothing bets. They trim risk first. They keep cash. They scale in slowly. They focus on quality, and they refuse to build a position so large that a few extra ugly weeks can destroy the plan. This part is boring, which is exactly why people skip it. Everyone wants the exciting answer: which stock, which ETF, which metal, which sector. But the unglamorous truth is that position size can matter more than the idea itself. A brilliant thesis with reckless sizing behaves like a bad thesis. Here is a cleaner framework. First, remove anything that can force you to act against your own judgment. Second, divide assets into cracked and bruised. Third, build exposure to the bruised names with the strongest balance sheets and clearest long-term demand. Fourth, watch for official behavior to shift from toughness to support. And fifth, accept that the best entry never feels obvious in real time. That framework matters because every crisis tells the same emotional lie. It whispers that today's pain is permanent. It makes people think the future will simply extend the mood of the present. When fear is intense, the mind becomes lazy. It stops imagining adaptation, intervention, recovery, and rotation. But markets eventually price those things whether the crowd feels ready or not. History keeps teaching this in different costumes: oil shocks, wars, credit scares, recessions, and even pandemic panic all looked unique while they were happening, and in some ways they were. But the market pattern kept rhyming. First the shock, then the overshoot, then the rescue attempt, then the rebound led by assets that were punished too deeply relative to their true damage. That does not mean every dip is a gift. Some businesses deserve to stay down. Some sectors face real long-term trouble. Some balance sheets are weak for reasons a rally cannot fix. But when fear becomes broad enough, good assets and bad assets often get mixed together. The opportunity comes from separating them before the crowd does. The highest returns in these periods usually do not come from the most dramatic story. They come from the biggest gap between price and reality. That gap opens when people stop analyzing and start reacting. A quality business can temporarily trade like a crisis casualty. A solid sector can get valued like a dead end. That is when patient money starts quietly getting interested. And remember, governments do not sit still forever while an energy shock bleeds through the economy. If oil stays high long enough, public anger rises, growth slows, election pressure grows, debt becomes harder to finance, businesses complain, consumers pull back. At some point, the political system stops talking about principle and starts talking about relief. That relief can show up in many forms: emergency supply coordination, diplomatic pressure, release of reserves, support for shipping and insurance, liquidity in the bond market, a softer tone from central banks, a package aimed at households or industry. Markets do not need a perfect solution. They only need a believable shift from denial to response. And when that shift arrives, the snapback can feel unfair. The people who spent weeks waiting for a clear invitation miss the best part. The people who bought what already doubled discover momentum is not the same as value. The people who studied the mechanism instead of the noise are the ones who suddenly look lucky, but it was not luck, it was preparation. So what matters most right now is not guessing the exact day the turn begins. That is a vanity game. What matters is understanding which assets are already crowded, which ones are unnecessarily crushed, and which signals suggest policymakers are moving from resistance to support. You do not need perfect foresight. You need a better framework than the crowd. If you like videos that help you think clearly when the market gets emotional, keep this channel in your corner, because this final point may be the one that saves people from the biggest mistake of all. Do not confuse a scary environment with a hopeless one. Those are not the same thing. A dangerous period can still contain extraordinary opportunity. In fact, that is often where the opportunity comes from. The crowd wants comfort, and comfort usually arrives after price has already moved. Prepared investors want asymmetry. That means limited damage if they are patient and wrong for a while, but powerful upside if the turn comes the way they expect. The market rarely hands out that setup during calm times. It appears when fear is loud, decision-making is sloppy, and everyone wants certainty they can never truly get. That is why this kind of moment matters more than people think. Not because every crisis creates instant riches, not because every beaten down asset is a bargain, but because periods of disorder expose who is thinking in headlines and who is thinking in chains of cause and effect. One group reacts to what is happening. The other group prepares for what usually comes next. If oil shocks the system, growth slows, officials soften and strong, but oversold assets recover. Then the real question is simple. Will you still be focused on the first headline while the second move begins? Or will you already be positioned in the places the crowd mocked, ignored, or sold too cheaply? That choice, more than the war itself, is what shapes the outcome. The people who do best in crisis are rarely the loudest, the boldest, or the most dramatic. They are usually the ones who stayed clear enough to notice when fear stopped being information and started becoming price distortion. They understood that panic can spread faster than damage, and they were ready when the market finally remembered the difference. In the end, the biggest gains do not go to the people who saw the fire first. They go to the people who knew where the exits, the sprinklers, and the rebuilding money would go after everyone else started running.